America powers on. We're going to put the image up for those who can see it on the screen. 1959 Cadillac, one of my favorite cars of all time. So give us your sense about why you think, boy, it's time to stay with U.S. equities.
First and foremost, our view of U.S. preeminence is intact, and that's why we chose that car. It is such an American-looking car. It's so clear. It can't be confused with cars from any other place. It also shows that America has been preeminent for quite some time. We have a great quote from Bruce Springsteen's song Pink Cadillac there, where people are saying, oh, after the global financial crisis, this was the end of the American century, and the century belonged to China, and our view is actually no, U.S. preeminence is going to continue for the long run, and that's driven by a number of factors, but that results in great earnings per share growth, very consistent, persistent, reliable growth, and that's why one should stay invested.
So if you look backwards, which you do in your outlook, actually, you have remarkable numbers. If you take on $100 million, you correct me if I'm wrong here, back in 2009, it would be worth just under $1 billion today invested in U.S. stocks, as opposed to if you took a developed markets, equities non-U.S., it would be 400 million, I believe. And if you did it in developing markets, it would be 318. China, 229 million, as opposed to just under $1 billion. That's a pretty extraordinary performance.
When we show these numbers to our clients, they are so surprised because, as you say, 100 million would be just under $1 billion just in U.S. equities, and not even a quarter of that in China. And for everybody who thinks of China's growth rate, it goes to show that economic growth alone doesn't drive equity markets or earnings per share growth. And so that's why when we tell clients stay overweight U.S. equities from a strategic long-term perspective, they look at that data and it's easier to persuade them to do that.
Such an important thing you said, stay in it. Because one of the questions is it time to take the money off the table? Because we always hear that disclaimer about past performance and future. And why isn't this a time to say, oh, you know what, I did pretty well in equities, I should put the money someplace else?
So there'd be three places people could put their money. One would be you could put your money in non-U.S. equities. And that is a function of whether you think earnings per share growth will be faster. Do you think economic growth is going to be more sustainable? Does one think that valuations are more attractive? Another place would be bonds and another would be cash. And we actually make the case that even though the returns for U.S. equities relative to all these other assets has been outsized since the global financial crisis, we still recommend stay with U.S. equities. And the argument there is that, first of all, when you're looking at cash and bonds, you're going to have substantially lower returns over the long run. Second one is you look at other parts of the world, even though valuations look expensive, you need to adjust for sector weights, meaning U.S. S&P 500 benchmarks have a lot more earnings from technology stocks. So you have faster growing companies, faster growing earnings per share relative to, for example, the UK equity market. It's really remarkable. S&P 500, when you look at the earnings, about 30% comes from technology. In the UK equity market, only 1%. So when you're looking at benchmarks, you need to adjust for sector weights. And then the U.S. is expensive, but not that expensive relative to other markets.
See, that was one of the things I got from your report I had not focused on, because I hear it's expensive, it's fully valued. If you look at price earnings ratios and things, it's pretty, historically, it's up there, right?
Yes.
According to where we've been historically. But you're saying if you really look at it the right way, it's not as expensive as you think it is.
Yes, it is correct that it's expensive. So if we look at its own history, it's what we call in the 10th decile, meaning equities have been cheaper 90% of the time. But when you look at it relative to other markets, you can't just look at the price to forward earnings, for example. You need to say, well, if an index has a lot more technology versus another index that has a lot more energy and financials, the one with a lot of energy and financials will look cheaper, but that's only because it has slower earnings growth. Once you make that adjustment, these other markets don't appear as cheap. Of course, China is the exception, but we actually don't recommend clients invest in China no matter how cheap it looks.
No, that's not too good. So there are some risks in your outlook. And it struck me in looking at them, it looks like they're pretty much all either geopolitical or straight up political.
That is correct. We start with all the things going on in the Middle East. So we start with the Israel-Hamas war. We look at Iran. We're saying, what is the risk there? What about Iran-Russia relationships? What does that mean? So everything related to the Middle East is on that list, and fears of escalation. It's not as if there's zero probability of even further escalation beyond what we've seen. Obviously, with what's going on in the region, risk of terrorism goes up. And then domestically in the U.S., we have it as our lowest risk. Even though people are very concerned about it, we don't think this kind of pessimism is warranted. There'll be volatility around the elections, but at the end of the day, the system of checks and balances in the U.S. and the strength of the institutions is what makes the country preeminent. So we think clients need to look past that and past that volatility.
But if you're worried about some of those risks, geopolitical, as you say, and to some extent U.S. political risk, does that mean bonds? Because you are getting paid now. You're getting real returns now on fixed income in a way that you weren't before.
If you look at it at a very basic level, you'd say, okay, U.S. equities in our base case, about 6% return, bonds around 5%. So why take any risk with U.S. equities? But with your bonds, there's not that much upside. But with your equities, we actually have a 20% probability to a 13% type return. So you're looking at a lot more upside staying invested. The other issue is if you sell your equities, you end up having to pay a lot of taxes. So let's say whether you're a New York resident, whether you're a California resident, and you've had equities for a long time, S&P 500 has to go down a lot to make up for all the taxes that one has to pay.
When you did your analysis of how well U.S. equities have done, what about large caps, small caps, different sectors? Are some the ones you really want to be in?
Our general recommendation to clients is not try to pick different sectors. So, for example, there's a lot of excitement about technology stocks and generative AI. We think generally there's probably a little bit too much hype about generative AI and the impact on earnings per share and broadly, and the impact in terms of that basket of stocks and improvement in productivity. We just say broad S&P 500, very good for the long run.